What's up, knowledge seekers? So you've been watching your investment account and it's a bloodbath. Everything's in the red, down arrows everywhere. Your friends are freaking out about market meltdowns and economic disasters. The financial news is full of doom and gloom, talking about crashes and catastrophes. You're probably wondering, should I sell everything and run for the hills? Should I double down and buy more? Or maybe just delete the app and pretend my money doesn't exist? Here's something that might surprise you. Some of the wealthiest people in history made their fortunes during the worst market crashes. While everyone else was panicking and selling, they were quietly buying. This could be your golden opportunity to build serious wealth. But wait, how is that even possible? How do you make money when everything is falling apart? Today, we're going to decode the mystery of stock market crashes. By the end of this video, you'll understand exactly why markets crash, whether you should be worried, and most importantly, how smart investors turn disasters into windfalls. Ready to learn how to profit from chaos? Let's dive in. Understanding market crashes. Let's start with the fundamentals. What exactly causes stock markets to crash? A market crash happens when stock prices plummet rapidly across the board. We're talking about significant drops in a very short time period. These crashes typically occur for three main reasons: speculative bubbles bursting, economic deterioration, and unexpected catastrophic events. First, let's talk about speculative bubbles. A bubble forms when asset prices inflate far beyond their actual worth, driven by excessive optimism and speculation rather than solid business fundamentals. Think of it like a party where everyone gets carried away. Prices keep climbing higher and higher until someone finally asks, "Wait, is this actually worth what we're paying?" The housing bubble of 2006 to 2007 provides a perfect example. Real estate prices skyrocketed as people believed property values would rise forever. Banks gave mortgages to anyone with a pulse, creating artificial demand. When reality hit and people realized many borrowers couldn't actually afford their loans, the entire system collapsed. The resulting crash didn't just affect housing, it triggered a global financial crisis that wiped out trillions in market value. Another classic example was the Japanese asset price bubble in the late 1980s. Tokyo real estate became so expensive that the Imperial Palace grounds were theoretically worth more than all the land in California. When that bubble burst in the early 1990s, Japan entered what they called the lost decade, actually lasting much longer than 10 years. The second major cause is economic deterioration and policy changes. When fundamental economic conditions worsen, things like rising unemployment, declining corporate profits, or excessive inflation, investor confidence erodes. People start selling because they expect companies to make less money in the future. Policy changes can trigger this too. When central banks raise interest rates aggressively to combat inflation, borrowing becomes more expensive for businesses and consumers. Companies that relied on cheap debt to grow suddenly find themselves struggling. Consumer spending drops as credit becomes costlier. This creates a domino effect that can send markets tumbling. The 1970s stagflation period demonstrates this perfectly. High inflation combined with stagnant economic growth created a toxic environment for stocks. The Federal Reserve had to raise interest rates dramatically to break inflation's back, but this also triggered recessions and market declines. The third cause is what experts call black swan events, completely unexpected disasters that nobody saw coming. These could be natural disasters, terrorist attacks, pandemics, sudden political upheavals, or major corporate scandals that shake investor confidence. September 11, 2001 exemplifies this category. The terrorist attacks weren't just tragic human events. They immediately raised questions about airline safety, insurance costs, military spending, and general economic stability. Markets closed for days, and when they reopened, massive selling ensued as investors grappled with this new reality. More recently, the initial COVID-19 outbreak caught everyone off guard. Within weeks of the first lockdown announcements, global markets crashed over 30% as investors realized the pandemic would shut down entire economies. Nobody had global pandemic in their 2020 predictions, yet it became the defining economic event of that year. These are the primary catalysts for market crashes. But here's what's crucial to understand. While the specific triggers vary, the underlying pattern remains remarkably consistent throughout history. Market cycles are natural. Here's something that might shock you. Stock market crashes are completely normal. Markets don't move in straight lines upward. They fluctuate in predictable patterns. If you're investing for the long haul, understanding these cycles is absolutely critical for your success. Think about it logically. If markets only went up, there would be no opportunity for traders to make money buying low and selling high. The ups and downs create the opportunities that make active trading possible. Financial analysts have identified 4 distinct types of market declines, each with different characteristics and frequencies. Let me break these down for you. First are pullbacks. These are minor price drops of roughly 5 to 10%. These happen constantly, sometimes multiple times per year, and they're considered completely normal market breathing. It's like the market taking a brief rest before continuing its journey. Next are corrections, more significant drops of 10 to 20%. The name tells you everything. The market is correcting from overvalued levels back to more reasonable prices. These typically occur every year or two and often provide excellent buying opportunities for patient investors. Then we have bear markets. Serious declines of 20 to 40% that usually last several months to a few years. These generally happen every 5 to 7 years and often coincide with economic recessions or major policy shifts. They're more intense and longer lasting than corrections, but still part of normal market cycles. Finally, there are true crashes. Devastating drops of 40% or more that can happen very quickly. These are rare, occurring perhaps once every 10 to 20 years, and they're usually triggered by those black swan events or the bursting of major speculative bubbles. Here's what's remarkable. Despite how scary these crashes feel when you're living through them, history shows an incredible pattern of recovery. Let me share some specific examples that prove this point. The 1973 to 1974 oil crisis crash saw markets drop nearly 50% over 2 years as oil prices quadrupled and inflation soared. It took about 7 years for full recovery, but those who held on through the pain were eventually rewarded with new highs. Black Monday in October 1987 was terrifying. The Dow Jones lost 22% in a single day, the largest one-day percentage decline in history. Yet within 2 years, the market had completely recovered and continued climbing to new records. The dot-com crash of 2000 to 2002 was brutal for technology stocks, with the Nasdaq falling over 75% from its peak. But even after that devastating decline, patient investors who held quality companies eventually saw full recovery and beyond. The 2008 financial crisis was perhaps the most frightening crash since the Great Depression, with markets falling roughly 50% and unemployment skyrocketing. Yet even that crisis saw complete recovery within about 4 years for those who stayed invested. Most recently, the COVID-19 crash of March 2020 saw markets drop 30% in just 5 weeks, but recovery was remarkably swift, taking only about 4 months to reach new highs. Notice the pattern? Different causes, different time frames, but the same ultimate outcome: recovery and new highs. The investors who lost money were those who panicked and sold at the bottom. The winners were those who stayed calm or even bought more during the chaos. But I know what some of you are thinking. Past performance doesn't guarantee future results. What if this time is different and we never recover? That's a fair concern, so let me address it directly. You should distinguish between normal cyclical crashes and true systemic collapse. Normal crashes happen when markets get overvalued or economic conditions temporarily worsen, but the underlying economic system remains functional. People still go to work, companies still operate, banks still function, and governments maintain stability. Systemic collapse would mean the complete breakdown of economic institutions. Banks failing en masse, governments defaulting on debt, widespread unemployment, and social order breaking down. This is extremely rare in developed economies and would require truly catastrophic circumstances. For major economies like the United States, the institutional framework is designed to prevent total collapse. Central banks can provide liquidity, governments can stimulate spending, and regulatory systems exist to maintain basic market function even during severe stress. So, while you should never invest money you can't afford to lose, historical evidence strongly suggests that patient investors in diversified portfolios of quality companies will eventually see recovery from even the worst crashes. Turning crashes into profit. Now for the million-dollar question. How do smart investors actually make money during market crashes? This might seem counterintuitive, but some of the greatest fortunes in history were built during the worst market conditions. As legendary investor Benjamin Graham said, "In the short run, the market is a voting machine, but in the long run, it's a weighing machine." Let me walk you through the most common mistakes people make during crashes, and what you should do instead if you want to build wealth during difficult times. The biggest mistake is emotional selling. When portfolios turn red, human nature screams at us to sell everything before it gets worse. This feels logical. Cut your losses before they get bigger, right? But here's the crucial truth. You only lose money when you actually sell. If you own shares of a solid company, those shares represent real ownership in a real business. The stock price might fluctuate wildly, but the underlying company hasn't disappeared. Consider this scenario. You own stock in a profitable grocery store chain. During a market crash, the stock price might fall 40%. But people still need to buy food. The stores are still operating, and the company is still generating revenue. If you sell at the crash price, you've locked in a 40% loss. But if you hold on, you still own the same profitable business that will likely recover when market emotions stabilize. Instead of panic selling, successful investors stay informed about their holdings and focus on long-term fundamentals rather than short-term price movements. The second major mistake is trying to time the market perfectly. Many investors attempt to predict the exact bottom of a crash, waiting for the perfect moment to buy. The problem is that nobody, not even professional fund managers, can consistently predict market bottoms. You might wait too long and miss the recovery, or you might buy too early and watch prices fall further. A much smarter approach is dollar cost averaging, or DCA. This strategy involves investing fixed amounts at regular intervals regardless of price. When prices are high, your money buys fewer shares. When prices are low, you get more shares for the same investment. Over time, this averages out your purchase price and removes the stress of trying to time the market perfectly. For example, instead of investing $12,000 all at once, you might invest $1,000 every month for a year. Some months you'll buy at higher prices, others at lower prices, but you'll end up with a reasonable average cost without having to predict market movements. The third mistake is buying low-quality companies just because they're cheap. When everything is on sale, it's tempting to grab whatever looks like a bargain. But there's a crucial difference between a temporarily discounted quality company and a fundamentally flawed business that deserves to be cheap. During crashes, strong companies with solid balance sheets, consistent profitability, and competitive advantages become temporarily undervalued due to market panic. Weak companies with high debt, declining revenues, or obsolete business models might stay cheap permanently because they're genuinely troubled. Here's a powerful real-world example. During the 2008 financial crisis, Apple stock fell from around $200 to below $80 per share. The company wasn't in financial trouble. It had strong cash flow, innovative products, and growing market share. Investors who recognized Apple's fundamental strength and bought during the crash saw incredible returns as the stock eventually rose to over $150, split-adjusted, by 2021. Contrast this with companies like Blockbuster or Kodak, which also saw their stock prices crash but never recovered because their business models became obsolete. The fourth mistake is inadequate diversification. Some investors put all their money into one stock or sector, thinking they've found a sure winner. But crashes affect different industries differently. Some sectors fall harder than others. Smart investors spread their investments across multiple sectors like technology, healthcare, consumer goods, energy, and financial services. This way, if one area gets hammered, other areas can help offset the losses. You can even diversify beyond stocks into bonds, real estate, or international markets for additional protection. If picking individual stocks feels overwhelming, consider exchange-traded funds, ETFs, or index funds that automatically provide diversification across hundreds or thousands of companies. This gives you broad market exposure without requiring expertise in analyzing individual businesses. The final mistake is following the crowd blindly. During crashes, fear and panic spread like wildfire. People make decisions based on headlines and social media rather than careful analysis. When everyone is selling, they sell. When doom and gloom predictions dominate the news, they believe the worst-case scenarios. But remember, even the most experienced professional investors can't predict market movements with perfect accuracy. What matters is understanding what you own and why you own it. Do your own research, understand the companies you're investing in, and don't let emotional reactions drive your financial decisions. If you're uncertain about investment decisions, consider consulting with a qualified financial advisor who can provide personalized guidance based on your specific situation and goals. Now, there's one advanced strategy that some professional investors use during crashes: short selling. This involves betting that stock prices will continue falling. You essentially borrow shares, sell them at current prices, and hope to buy them back later at lower prices, keeping the difference as profit. While some legendary investors have made fortunes shorting during crashes, this strategy is extremely risky and complex. If you are wrong and prices rise instead of fall, your losses can be unlimited. I'm mentioning it for educational completeness, but I don't recommend it for most investors, especially beginners. The key takeaway is that market crashes create opportunities for patient, informed investors who can stay calm while others panic. Quality companies become temporarily undervalued, creating potential for significant long-term gains. So there you have it, the complete guide to understanding and profiting from stock market crashes. While crashes feel terrifying when you're experiencing them, they're simply part of the natural market cycle that has repeated throughout history. The evidence is clear. Major stock markets have consistently recovered from every crash and reached new highs over time. While past performance doesn't guarantee future results, the pattern suggests that recovery is likely unless we face complete economic system collapse. The secret to surviving and thriving during crashes is maintaining perspective, avoiding emotional decisions, conducting thorough research, and purchasing quality investments at discounted prices. Remember, panic sellers lose money, but prepared investors turn market chaos into their greatest wealth-building opportunities. When the next crash arrives, and it will eventually, don't let fear control your decisions. Instead, view it as a potential opportunity to acquire great companies at bargain prices. Stay informed, stay diversified, and stay focused on your long-term financial goals. If you found this crash course helpful and want more beginner-friendly investment education, smash that like button and subscribe to Knowledge for Dummies 101. What investment topic would you like me to break down next? Let me know in the comments below, and I'll make it happen. Remember, knowledge is your best investment protection. Thanks for watching, and I'll see you in the next video.